Welcome to the Deep Dive. We take your sources, really unpack them, and give you those crucial insights fast. Basically, your personal shortcut to getting properly informed.
Exactly.
And today, we're digging into something that affects, well, everyone. Figuring out your own personal financial health.
Right. You sent over this chapter evaluating the financial position of clients. And our mission here isn't just definitions. It's about giving you practical tools, the how-tos from these principles to actually assess your own situation.
Okay, let's jump right in then. The chapter kicks off with cash flow management. Sounds simple, maybe, but it calls it the foundation. Why is managing money in and out like the absolute starting point?
Well, think of it like the engine of your finances. It's absolutely fundamental. And it's not just about the total amount, it's crucially about the timing.
The timing, right?
Yeah, the chapter nails this. You need to line up when money comes in with when your bills go out. If you get paid monthly, you need that cash ready for rent, loans, all that regular stuff.
Yeah, and if it doesn't line up, it's not just about late fees, is it? Even a small hiccup can cause problems.
Oh, absolutely. That mismatch. That's how you end up leaning on credit cards or short-term loans. And the chapter points out the interest on that debt is just an extra outgo. It eats into your money.
A cycle you really want to avoid.
Exactly. Plus, good cash flow lets you build up a surplus. Savings.
And that surplus, that saving, it's not just for holidays or big purchases, is it? The chapter talks about difficult times.
Precisely. It's your safety net for when things go sideways.
Yeah.
And look, mismanaging cash flow isn't just inconvenient. The chapter mentions tension, disruption. It can even affect your health if it gets bad.
Wow. Okay, so getting cash flow right gives you, what, a sense of security? Control.
Yes, control and empowerment. Those are the words the chapter uses. It really puts you in the driver's seat.
Okay, that makes sense. So to get a handle on this cash flow, we need the household budget. Sounds bit daunting, maybe. What are the key bits we need to grasp?
Think of it as your financial map. The chapter mentions advisors helping with this. The basics are income, where money comes from, expenses, where it goes.
Simple enough.
And savings, what's left. Income can be steady, like salary, or maybe variable, like investment income.
And expenses aren't just one lump sum, right? The chapter breaks them down.
Right. You've got mandatory stuff, non-negotiable, like loan payments, taxes, then essential living daily needs, groceries, utilities, that sort of thing.
Okay.
And finally, discretionary spending, the wants, not the needs, entertainment, lifestyle stuff you could theoretically cut back on.
So income minus all those expenses equals your savings.
That's the bottom line.
Got it. Now, the chapter also talks about monthly surplus in hand versus savings. What's the difference there? Why look at both?
Ah, good point. This is subtle but important. Your monthly surplus in hand is the cash left over in your account after things like, say, your provident fund or pension contributions are automatically taken out.
Okay, the money you can actually touch right now.
Kind of, yeah. But your total savings includes those deductions too, because that money is still being put aside for your future, even if it's not in your current account.
Right, so the in-hand bit might look smaller, but you're actually saving more overall if you count those deductions.
Exactly. You need to see the whole picture.
The chapter uses an example needing 6 months of expenses covered, like ours $91,000 a month in their case. That really drives home the need for reserves.
It does.
And then there's that detailed budget table, the ABC Family one, table 3.1. What does that show us?
Oh, that's a great illustration. It lays it all out. You see their salary, some investment income, adding up to their total income, or ours $1,037,000. Then it lists all the expenses broken down, mandatory like PF and tax, essential like groceries, school fees, rent, and discretionary like entertainment. Total expenses. Ours $1,012,000.
Okay.
But crucially, it also shows they're actively making investments of ours $18,000. So after tax and PF, their take home is ours $1,016,000. The surplus in hand is only ours $7,000.
Right, the smaller number.
But their total savings, including the PF and the separate investments, is RS $34,000. That gives them a savings ratio of nearly 25%. See? It shows exactly where the money is going.
Yeah, seeing it itemized like that makes it much clearer. Okay, so that's budgeting. The chapter then talks about cash management inflows and outflows. Sounds similar to budgeting.
It's related, definitely.
Yeah.
But cash management is more about the here and now, the immediate availability. Your budget might say you have a surplus, but do you actually have the cash accessible when a bill is due? It's back to that timing thing.
Right. Making sure the plan works in real time. And the Sunita example, that hits this point home, doesn't it? earning 50K, but maybe missing 15K in reimbursement she hasn't claimed yet.
Exactly, leading to a cash crunch. It shows your theoretical income isn't always the cash you have available today.
Yeah.
And the chapter also says, even if you earn enough overall, if too many bills hit early in the month, you can still run short temporarily.
So it's the rhythm of payments, not just the totals. The chapter says you need a readily available surplus amount in the bank or whatever for these short-term bumps. How's that different from an emergency fund?
Good question. That accessible surplus is for smoothing out the normal monthly ups and downs. Like if your electricity bill is higher one month. An emergency fund, though, that's for the big shocks.
Like losing your job.
Exactly. Or a major medical issue, something that disrupts your income stream significantly. This day-to-day cash management buffer is smaller, more immediate. The chapter says it's at the heart of every budget.
Okay, budget is the plan. Cash management is making the plan work daily. Got it.
Yeah.
Then there's the income and expenditure statement. How's it different from a budget? Budgets look forward, right?
Precisely. The budget is your forecast, your plan. The income and expenditure statement, that's looking back. It shows what actually happened over a set period, a month, a year. Your actual income earned, your actual expenses paid.
So you can compare it to the budget and see where you went off track.
Exactly that. See where the reality differed from the plan.
And it's slightly different from just looking at your bank statement, right? Something about timing again.
Yes. For example, salary earned at the end of month A, but paid in early month B. The income and expenditure statement might record it in month A when it was earned. Or a credit card purchase made in month A, even if you don't pay the bill until month B, gets recorded as an expense in month A. It gives a truer picture of activity within that specific period.
Okay, so it's a rear view mirror. Helps you learn from the past. Which brings us nicely to budgeting and forecasting. We've done budgeting, but what's forecasting in this sense?
Well, the chapter stresses, adequate income, controlled expenses. That's key for the future. Budgeting manages that. Forecasting is about looking further ahead, trying to predict future financial situations.
Like anticipating changes.
Yeah. The chapter lays out budgeting steps again. List income, deduct mandatory costs, then essential, then discretionary. See what's left for savings.
And if savings aren't enough, it suggests focusing on trimming expenses, discretionary first, maybe essential ones too, or even looking at debt options if loan payments are crippling you.
Exactly. Now, forecasting builds on that. It's about making informed guesses about the future based on what you know now and what you expect to change. Maybe a pay rise is coming, or a big expense like university fees.
So it's not just pulling numbers out of thin air.
No. It needs a basis. It considers changing conditions. It relies on assumptions. Sometimes you might even need expert input. Experience helps too, obviously. It's dynamic.
And this forecasting can feed back into creating a more realistic budget for the future, right?
Absolutely. It can be the foundation for your next budget cycle.
Okay, makes sense. But just making a budget isn't enough, is it? The next section is crucial. Monitoring budgets and provision for savings.
Oh, completely vital. The chapter's really clear. Making the budget is step one. Monitoring, tracking your actual income and spending against that budget. That's where the real learning happens. That's what informs your decisions.
And you look at the differences, the variances.
Yes. Those variances tell you so much. Where are you consistently overspending? Where did you underestimate income? That's gold dust for improving your budget next time.
Like the example of transport costs always being higher than budgeted. You only know that if you track it.
Exactly. You can't fix what you don't measure. It's continuous. You monitor, you learn, you adjust the budget. It gets better over time.
And the ultimate goal of all this tracking and adjusting
is to make sure you have that surplus, savings, for whatever you need it for in the future, goals, retirement, whatever. And the amount you save needs to match your specific needs.
Right. And if there's a gap, if you're not saving enough for your goals, the chapter has tips.
It does. Practical things like set a specific savings percentage target. Actively hunt down and cut wasteful spending. Be disciplined about discretionary costs.
Don't just spend a pay rise. Maybe save it.
Yes. Direct any windfall straight to savings, and probably the most effective. Make your savings amount a fixed figure in your budget. Treat it like a bill you have to pay to yourself.
Pay yourself first. Classic advice. Okay, those are really concrete actions. Now, shifting perspective a bit, the chapter talks about getting a snapshot, creating a personal balance sheet, and understanding net worth. This sounds more formal.
It is, a bit, but incredibly useful. A balance sheet is just a picture of your financial position at one specific moment in time. It lists assets, what you own, and liabilities, what you owe.
Assets like house, car, investments, cash.
Exactly. Physical things like property and financial things like stocks, bonds, bank balances. Liabilities are your debts, mortgage, car loan, credit card balances, student loans.
And net worth is.
Simply assets minus liabilities. It's the bottom line of your financial health at that moment.
And the chapter links us back to income, saying income fuels the savings that buy the asset.
Right. Income is the starting point. Savings build assets.
Yeah.
The chapter then distinguishes between asset types. Physical assets tangible, can hedge inflation, potential for big growth, but maybe illiquid, need big investments sometimes, like real estate, gold,
Okay.
and financial assets. Things like stocks, bonds, mutual funds, they represent a claim, often easier to trade, easier to value, you can invest smaller amounts. More regulated, usually.
Makes sense. And the chapter warns about using debt to get assets, because debt is a liability.
Yes. Taking loans increases liabilities and puts pressure on future income for repayments. It distinguishes between, say, a mortgage for a house, an appreciating asset, hopefully, which can build long-term wealth, and maybe borrowing heavily to gamble on stocks, which is much riskier.
Gotcha. And Lakshmi's balance sheet example really shows this net worth idea in action.
It does. Her assets, house, investments total are $36,022,000. But her liabilities, mainly home and car loans, are ours, $12,007,000. So her net worth is ours, $24,015,000.
So even with lots of assets, the debt pulls the net worth down.
Exactly. The chapter makes the point. Net worth is often a much better indicator of your real financial position than just looking at the total asset value. You want to see that net worth figure growing over time.
That's a key takeaway. Okay, so knowing your net worth is important. The chapter then kind of brings it all together with practical steps for creating a budget and savings plan. Feels like a how-to summary.
Pretty much. It lists the steps. Gather all your income and expense info. Don't miss anything. Base your budget figures on past actuals or known future changes.
Right.
Adjust for the specific budget period, like higher heating bills in winter, maybe a planned holiday cost. Include a buffer, a contingency for surprises. Figure out how much you need to save for your goals.
And the crucial last step.
Allocate that savings amount first. Move it to your investment or savings account right away so you don't accidentally spend it. Make savings a fixed, non-negotiable line item.
Solid advice. Plan, track, prioritize saving. Now, life throws curveballs. The chapter moves on to contingency planning, preparing for the unexpected. What risks should we think about?
Several big ones. If you're a dual income family, what happens if one income stops? Life insurance is key there. Healthcare costs huge potential risk. Medical insurance is the main buffer.
Job loss.
A risk for anyone. Having two incomes helps cushion it, but an emergency fund is the real safety net here.
The rule of thumb for that emergency fund is?
Generally aiming for 3 to 6 months worth of essential living expenses. Kept somewhere very safe and very liquid, easy access savings account, maybe short-term deposits.
Not tied up in stocks.
Definitely not. Needs to be there when you need it, instantly. And you need to review it, top it up if you use some.
What else? The chapter mentions separation divorce.
Yeah. Acknowledges the financial impact. Briefly touches on prenups, though notes legal status can be iffy depending where you are. More practically, it stresses having a fair split of assets and debts between partners, things like joint ownership where appropriate, maybe separate accounts for managing personal versus household money.
Okay, sensible precautions.
Yeah.
So we've budgeted, saved, planned for emergencies. The final piece seems to be measuring progress. Evaluation of financial position using ratios, like a financial health checkup.
Exactly like that. Just like companies use ratios, we can use them for personal finance. They give you a numerical snapshot, help you see trends, identify areas needing work.
Okay, let's run through the key ones the chapter mentions. First up, savings ratio.
Right. That's your annual savings divided by your annual income times 100. Remember the ABC family. Theirs was lowish, 10%. Another example, XYZ, had 31.4%, much better. It shows what proportion of your income you're actually putting away.
And the flip side is the expenses ratio. Annual recurring expenses divided by annual income, or just 100% minus your savings ratio.
Correct. For ABC, it was 90%. Tells you how much of your income is going out the door on regular expenses. Remember to annualize things like holidays for a true picture.
Okay. Then, total assets and total liabilities. We covered those for the balance sheet, what you own, what you owe.
Yep. Assets are current value of physical and financial stuff. Maybe exclude personal items for a stricter view. Liabilities are all debts.
Which leads to the leverage ratio. That's liabilities divided by assets, right?
Yes, times 100. The investor example had 20%. Basically shows how much of your asset base is funded by debt. Higher means more risk.
And net worth, again, assets minus liabilities. The investors was 1852 lakhs. Key figure to track.
Absolutely. And closely related is the solvency ratio. Net worth divided by total assets times 100, or just 100% minus the leverage ratio. The investor had 80%. Shows your ability to cover debts if you sold everything. Positive net worth is the minimum goal here.
Right. Then we get into liquidity. Liquid assets. What counts here?
Stuff easily turned into cash. Savings accounts, maybe very short-term FDs, liquid mutual funds, not usually things like shares or property. Needs to be quick access, stable value.
And the liquidity ratio uses that. Liquid assets divided by monthly expenses.
Exactly. The NFG example calculated theirs at 8.66 months, meaning they had enough liquid cash to cover nearly 9 months of expenses. The chapter suggests 4 to 6 months is a comfortable target, enough buffer for emergencies.
Makes sense. It also mentions a liquid assets to net worth ratio.
Yeah, interpretation there depends more on your life stage and goals. Younger persons saving for a long term might have a lower ratio. Someone nearing retirement might want more liquidity relative to their total net worth.
Okay. Next, financial assets ratio. Total financial assets divided by total assets.
Right. Shows how much of your wealth is in things like stocks, bonds, funds versus physical assets like property. The PQR example had 54%. The chapter suggests a higher ratio is often better as you near goals, as financial assets are generally easier to access or adjust.
And the last big one, debt to income ratio. Sounds important.
Very. It's your total monthly debt payments, mortgage, loans, credit card minimums divided by your gross monthly income times 100. The example was 40%. The general guidance mentioned is that anything over maybe 35–40% is getting high, could indicate you're overstretched on debt payments relative to your earnings.
Wow, okay. That's a lot of ratios, but they paint a really detailed picture together.
They do. And the key, as the chapter says, is not just calculating them once. It's doing it regularly, maybe annually, and tracking the trends. Are things moving in the right direction? Are your actions having the desired effect? Benchmarks are useful, but comparing you to you over time is crucial.
So wrapping up this deep dive, it really feels like taking control of your finances involves several connected steps. Understanding cash flow,
Critically important.
budgeting effectively, tracking your net worth with a balance sheet, planning for those unexpected bumps,
Essential contingency planning.
and then using these ratios periodically to measure your overall financial health and guide your decisions. It's a complete framework.
It really is. This chapter gives you the tools to move from just hoping things work out to actively managing your financial well-being.
Absolutely. So thinking about everything we've just unpacked, all those concepts, those ratios, here's a thought for you listening. What's one single concrete step you could take maybe this week to get just a bit more clarity or a bit more control over your own finances?
Yeah, maybe it's finally calculating your net worth, or just tracking your spending for 3 days straight, or figuring out that debt-to-income ratio. Even a small action builds momentum. Just take that first step.
Great final thought. Thanks for joining us for this deep dive.